The ongoing thing of gold and monetary metals, and I call them monetary as opposed to like platinum, palladium, which are precious, but there's a difference between precious and monetary. 3,000 years of history, gold and silver being money. Okay. Uh, if you look at, like, go to a Federal Reserve St. Louis, their Fred chart, they call them, and go to an M2 chart, money supply. Okay. And just look at it. Go back 50, 70 years, however far back they go, a long time. And look at, and move your little arrow along and like go to the first of the decade, January of 1970, and then go to January 1980 and 90, and write down the number. What was the money supply then? It's parabolic. Okay. And meaning the decay in the real value of the stuff in your wallet. We're a miniature, most countries in the West are, miniature versions of Venezuela. Okay, we made fun of that a couple of months ago. We put a Venezuelan stock chart on page one and said, boy, we should be long Venezuela.
Gold price swings have astonished many market analysts. Gold has risen steadily, marginalizing bears. Gold has left the 3,400-3,500 region without topping after nearly 5 months of consolidation. Gold typically peaks through sudden rises followed by fast reversals rather than prolonged stagnation. The metal's rising trend suggests a deeper fundamental change. Those expecting a rebound to $2,800 are disappointed by the price action, which suggests a far wider breakout trend. Michael Oliver, a veteran technical analyst, sees this as more than just another bull market phase. Oliver, who has over 5 decades of expertise since gold ownership was legalized in the U.S., believes this could be one of the biggest price events in gold history. His analysis of long-term momentum and log-scale charting shows a pattern similar to 1979, 1980, 2010, and 2011 surges. The lack of correction in recent months supports the idea that momentum is just beginning to accelerate, he says. Oliver believes we are entering a powerful parabolic period that could push gold above its current highs. People may be surprised by this phase's volatility and rapidity. Gold is currently dominant, but silver may soon take over. Michael Oliver considers the silver-to-gold spread a key indication, which has historically triggered dramatic silver rallies. Silver has lagged behind gold for most of the cycle, but it is presently outperforming. Oliver notes that silver surges more than gold when it breaks out. Silver's value is well below historical standards. If the spread grows, a vertical move may be imminent. Based on similar prior cycles, Oliver believes this breakthrough might double or triple silver prices within months, which is too significant to ignore. Michael's interview excerpts follow. To get timely information, subscribe to our channel and click the bell. Hope you enjoy the video and thanks for helping.
Everybody tries to find in any market trend a reason for it. And usually the reasons for a bull trend or a collapsing market, either way, is one, they got too extreme for too long, either too high or too low. Case of silver, we argue, too low for too long, especially on a relative basis to gold. And then when they turn up, they don't need a reason. The reason already occurred and was ignored. And so people are looking for a headline like, well, why is silver gold? Why is gold going up? Why was this stock, et cetera, et cetera. And usually it's stuff that's embedded, already built into that market that it needs to do. Okay, anyway, that's a broad comment, but I think it applies. The ongoing thing of gold and monetary metals, and I call them monetary as opposed to like platinum, palladium, which are precious, but there's a difference between precious and monetary. 3,000 years of history, gold and silver being money. Okay. If you look at, like, go to a Federal Reserve St. Louis, their Fred chart, they call them, and go to an M2 chart, money supply. Okay. And just look at it. Go back 50, 70 years, however far back they go, a long time. And look at, and move your little arrow along and like go to the first of the decade, January of 1970, and then go to January 1980 and 90, and write down the number. What was the money supply then? It's parabolic. Okay. And meaning the decay in the real value of the stuff in your wallet. We're a miniature, most countries in the West are, miniature versions of Venezuela. Okay, we made fun of that a couple of months ago. We put a Venezuelan stock chart on page one and said, boy, we should be long Venezuela. because the chart is parabolic, the stock market. And you say, well, that's great. No, it's not, because the degradation of the money ongoing constitutes the explanation of why the thing's going straight off the page. So is the price of dog food or a roll of paper, was exploding as well. Well, when you go back, that many decades in the U.S., basically the money supply increases about 90%, almost doubles, in other words, every decade. Sometimes more, sometimes less, and especially when the central bank gets nervous about this, that, or the other data point. Usually that's associated with the stock market downturn when the data points really start to go sour. Then they start printing more, okay? Well, gold goes up and holds its value against that ongoing degradation. And silver does too, although it's been lagged, especially over the last couple decades, to what gold has been doing. Gold's way above its 2011 high. Heck, copper is above its 2011 high. And there's a lot of base metals out there that if you circle where you are now and go back to where, 10, 20, 30 years ago, you think, gee, silver. Silver has made a mistake. Investors in silver have made a mistake. This happens in markets. You've got enough experience. If you go back to 2007 and 8, the market collapsed for reasons that, the guys in the story, they knew why it was going to collapse. They knew a couple years ahead of time, and yet the market wouldn't do it. And then finally it did collapse and paid its dues for that which it already had done and failed to compensate for. So I think silver right now is in one of these situations where not only is monetary metal going up, gold especially, the mama market, and silver's coattailing it, still very undervalued to gold, but it's catching up and it's erasing years of underpricing relative to a lot of things, to gold, to the degradation in the money unit. For example, if you just arbitrarily go back a quarter of a century, it'd be the October of 2000, okay? And look at the S&P. Right now it's up 3.5-fold from where it was then. It's actually less than the degradation in money almost. Gold's up 11+-fold, okay? So it's held its value against degradation of money. And that's a factor that's ongoing in all markets. And there's times when, let's say, the stock market reaches a bubble point where it's been ridiculous for too long, overpriced versus reality. And there's a lot of fundamentals out there that, that normally look at, the earnings and so forth. And those don't seem to work precisely, but they're a ballpark warning. And yet it's still up there. So markets make mistakes. And when they do, the erasure of that mistake is often horrendous. Like, let's say the .com top, NASDAQ 100, for example. When it turned down, S&P went down 2 years to 2002, 50%. NASDAQ 100 went down 82%. You talk about cleansing, okay? And it wasn't that what it was up there for was wrong. In fact, the .com bubble was totally valid. It changed our lives more than people even thought, and the internet did. And yet it still erased 82% of it, and it took it till 2016 for the NASDAQ to even get back to the price it had been in 2000. So, the point being that a lot of these things that happen, like if the stock market's going to top, as we argue it's topping, or the monetary metals are going to accelerate now, it's because of not factors that are necessarily new headlines, but old stuff that's finally getting recognized. And I think that's where we are at a very dramatic point, especially for silver.
Based on the imminent breakout in silver and the accelerating momentum in gold, analyst Michael Oliver anticipates that the precious metals market is on the brink of a critical inflection point. The recent behavior of gold, which has breached resistance after months of close consolidation, indicates that this is not a typical rally, but rather the initial phase of a significant structural shift. The absence of an abrupt topping pattern, which historically precedes reversals in gold, further supports the notion that this advance is still in the process of developing. Gold's continued ascent may suggest a reevaluation of its significance in a fragile monetary environment, as investors who anticipated a more substantial decline have refrained from investing. Oliver, who has spent decades monitoring long-term market cycles, is of the opinion that this moment could signal the commencement of one of the most significant movements in the modern history of gold. Against this backdrop, silver may offer an even more compelling opportunity. Oliver's analysis indicates that the silver-to-gold spread is approaching a breakout level that has historically resulted in a significant increase in silver prices. This type of arrangement has resulted in silver's value doubling or tripling within months in previous cycles, particularly in 1980 and 2011. Silver could experience a significant increase in price, potentially reaching levels between $100 and $200 per ounce if the spread breaches its critical ceiling and current patterns persist. This would not be merely a technical rally, rather it would be a repricing of silver within the context of a more extensive monetary shift. The mining industry's structure anticipates a limited new supply, which could result in a significant imbalance if demand increases abruptly. We should return to the interview.
Is that one, it's anticipating, and gold is, remember, gold's not some dumb market that follows headlines. There might be a day here or there where, oh, something happened in Iran, we dropped the bomb and therefore, whatever. These excuses come and go. People like to latch onto them and say, well, that's why it happened, okay? But it's ongoing, and gold knows that if, one, we have the biggest stock market bubble in U.S. history, which we've been arguing you do have, both in terms of age of the bull market, most of the bull markets in the past that we call bubbles, like the .com or 29, they were only 4 or 5 years. And the multiple gain was like 3 or 4-fold at most. And then you still collapse. Well, we've gone up, 20-fold in the NASDAQ since 2009. S&P's gone up maybe 10, 11-fold since 2009 low. Which, because, 700 level on the S&P. And the duration has been like triple the norm. And you can look at a money supply chart or a Fed funds rate chart, the short end of the market, of the debt market, and see why. Because we've been given a Cheech and Chong injection of happy money, free money. In fact, 10 of the last 15 years, the rates were effectively zero. You go back 75 years, and even when they raise rates to 5%, that's low compared to the last 75 years. That's in the lower quadrant of the rate levels. Okay, so the stock market's been fueled by free money. And that's why, like, the stock market's up today. Why? Great unemployment report. Why is it great? Because it means the Fed's are going to cut and print. They got more excuse to print. And that's all we care about. Give us more injections, boys. And that's what's, well, in effect, it's a miniature Venezuela market. Print the money, will go up, okay? So will the price of when I was a kid, a loaf of bread was 20 cents, okay? What is it now? When your granddad built a house, it cost, the median price was $4,500. Now it's $450,000, okay? What does that reflect? Degradation in the money unit, period, okay? And when the Fed has more incentives in this ECB and the Bank of Japan have more incentive to print, that money goes somewhere. Now, quite often it'll go to the stock market, but even the stock market historically will get to a point where it says, golly, I've gone too far with this game. And it breaks. And when it starts to break, people with assets who are smart will begin to get out and move somewhere else. It's never the case where everything goes down. That argument is not true. Gold has always risen in bear markets. Back in the 1930 to 32 bear, after the crash, we had a big rally in the stock market back halfway to the high, and then the bearish market started. It went down like 80%. Gold miners, you couldn't buy gold because it was illegal. Okay, government knows best. But homestake mining went up like 1,000%. Okay, during the huge bear market in stocks. Similarly, 2000, 2002, stock market went down big. What did gold do? It was advancing. It kept advancing till 2011. 2007 to 2009, stock market went down big. During that time, except for a month or two in there, an interruption, gold went up big and continued on up big. So the money goes elsewhere. Gold is getting some of that money already, not just, certainly not from U.S. investors, but from foreign investors, governments as well. But when the U.S. stock market shows another fracture, not that headline chasing sell off that we had in April, tariffs would sell it, okay? The reason for the market to go down is not some new news. It's based on, one, the massive excess of the past 15 years finally has reached a point where even if they keep printing, it won't help. Why? Because in 2000 to 2002, the Fed printed like crazy to save that bear market from happening. It didn't work. They started cutting rates in 2007. In fact, that's what printed the top.
Silver is on the brink of a substantial price increase as it approaches a critical breakout point in relation to gold. Silver can experience rapid and substantial gains within a matter of months once critical resistance thresholds are breached, often multiplying its value several times over, as historically demonstrated. This implies that silver has the potential to reach unprecedented price levels in a relatively short time frame when considering contemporary economic conditions and diminished purchasing power. Market participants who vacillate may be at risk of entering late into a rally that could be both swift and significant. Silver presents a compelling opportunity from a strategic investment perspective as a result of its inherent supply constraints and prolonged undervaluation. The metal's capacity to meet increasing demand through increased supply is significantly restricted by its dependence on byproducts from other mining operations. As demand increases, this structural imbalance may result in substantial upward pressure on prices. If these dynamics occur as expected, the price of silver could experience a significant increase, which would place those who were late to the market at a disadvantage. In hindsight, the current price levels may be considered to be highly attractive entry positions. If silver begins to ascend to significantly higher valuations, it would be one of the most significant developments in recent commodity history. Please provide your feedback on Michael's analysis in the remarks section below. If you find this video to be informative, we would appreciate it if you would consider supporting us by turning on notifications to remain informed about our most recent videos. I will see you in the video that follows. I appreciate your attention.